The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltale's Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the Cash Flow Desk.
Quick note, the show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. This was the week the AI build got signed, not paid. In 5 days, Samsung committed to a chip supply agreement with Broadcom worth more than $200 billion. Apple committed to years of US-made custom silicon with the same company. AMD wrote an equity check to a customer so that customer could buy AMD's racks. And Oracle got its credit rating cut for spending. Almost none of that turns into cash this year. On Wednesday's show, episode 2630, Hunt, Jason, and Mike walked all 20 pages of the cash flow memo and came at this from the other direction. As the models commoditize, the value moves to the infrastructure. This week, the infrastructure sent out its invoices. We're going to look at who can actually collect. Broadcom spent this week getting paid by both sides of a fight it isn't in. Samsung signed a memorandum of understanding worth more than $200 billion. High bandwidth memory, leading edge foundry, advanced packaging, running through 2030. 2 days earlier, Apple committed to a multi-year program with Broadcom to design and produce custom silicon and wireless connectivity for US-made chips, per Apple's own newsroom. Same week, opposite ends of the supply chain. Marcus, who's paying for that plumbing?
Broadcom doesn't have to pick a winner in the GPU war. It bills the participants. The memo has it at 52 times trailing free cash flow, fiscal Q2 10Q confirmed, on about $36 billion of trailing 12 free cash flow, up roughly 53% from the prior 12 months. That multiple isn't cheap, and it isn't pretending to be. What it's asking is that the 2030 end of those contracts is real. The test on the next print is whether the AI semiconductor line keeps compounding once the memory allocation is locked in.
And here's the part that doesn't show up in the headline. When AMD launched its Helios rack this week, we'll come back to that, SemiAnalysis found each rack needs 12 Broadcom Tomahawk switches, and that roughly 85% of the scale-up links inside it run through Broadcom retimers, 500 plus of them per rack. Broadcom is the only merchant supplier with silicon fast enough to do that job. Marcus, what does that do to the Broadcom case?
It means Broadcom gets paid on an AMD share gain and on an AMD share loss. That's a different kind of asset than a chip company. The risk isn't demand, it's concentration. The International Trade Commission opened an investigation this week into Samsung memory products and several customers, including Broadcom, on a patent complaint from Netlist. When your position depends on being the only supplier who can do the thing, patent risk is the thing that ends it, not the order book.
And then there's the company that already collected. GE Vernova generated $5.1 billion of free cash flow in the second quarter alone, more than the whole of 2025, per the company's release. Orders grew 88% organically. Gas power equipment backlog plus slot reservations went from 100 gigawatts to 116, and management now expects at least 125 by year end. Total performance obligations are $176 billion as of June 30th, and almost exactly half of that is services, not equipment. And per Talnex's hiring data, Vernova opened 284 new roles in the last 7 days against about 2,200 open, top 5 hiring velocity across everything Talnex's tracks. That's a backlog turning into payroll.
Everybody else this week announced Vernova collected. The memo has it at 21 times trailing free cash flow, Q2 10Q, filed Wednesday on $12.4 billion of trailing 12 free cash flow. Net debt against that is about a third of a turn. Broadcom's multiple is priced off cash that's contracted. This one is priced off cash that already cleared the bank. The services half of that backlog is the part I'd underline. Equipment backlog is a promise to build something. A services backlog on installed turbines is an annuity on machines already spinning, and it's the half that doesn't care whether the next gigawatt gets financed. What would change the take is wind. Management is still carrying an EBITDA loss in that segment for the year, and Vineyard Wind sued in April to stop them exiting a supply agreement. Vernova is also lining up grid contracts in Venezuela, which is its own category of risk. The gap between those two multiples is most of the week in one number. 52 times is priced off a contract book that starts converting toward the end of the decade. 21 times is priced off cash in the bank. I'd weight the contract timing risk higher than the market is right now, and I'd watch the 2027 order book on both names.
Two American chip companies had the best week either of them has had in years, and neither one of them got paid for it. Page 3 of the memo, same 7 days, completely different reasons the cash isn't there. Advanced Micro Devices is putting up to $5 billion into Anthropic, and Anthropic is deploying up to 2 gigawatts of AMD's MI450 GPUs inside AMD's Helios racks. Helios entered full production this week, with Microsoft named as a new customer and Cerebras signed as a technical partner. Intel, on the same page, printed $16.1 billion of second quarter revenue, up 25% year over year, the strongest growth rate since 2011, and its seventh consecutive quarter beating guidance. It landed Fortinet as the first named external customer of its foundry, and it lost $11 billion in the quarter on layoff and restructuring charges. Marcus, which one of those is the market getting wrong?
AMD just financed its own order book. An equity check into a customer who then buys the racks isn't a sale. It's a vendor loan with a purchase order stapled to it. The memo has AMD at 97 times trailing free cash flow, Q1 10Q confirmed, on $8.7 billion of trailing 12 free cash flow, a 1% yield. That's the price on a company whose largest new deployment is partly funded off its own balance sheet. What I'd watch is whether Helios revenue shows up in the August 4th filing or stays in the press releases.
A vendor loan with a purchase order stapled to it. Noted. There's a counterweight, and it landed the same week. Semi-Analysis reported that AMD's MI455X is the first data center silicon on 2 nanometer, ahead of everything it competes with, and in the same note that AMD's software gating massively regressed, with 90% parity against CUDA slipping from this summer out to October.
That's the whole AMD question in one sentence, and it isn't a hardware question. AMD has been ahead on paper before. The reason the 97 times multiple is a stretch isn't the silicon, it's that a customer can't run the silicon until the software clears parity, and that date has now moved. Anthropic's commitment doesn't accelerate a compiler. I'd weight the odds of Helios revenue landing on the original schedule at about 50-50, and October is the date that settles it. Intel's problem was never the revenue line. Going into this print, the memo had no multiple to quote at all. Trailing free cash flow was negative $2 billion at the Q1 10Q against $13 billion of trailing capex. That's a company paying for a fab network out of an income statement that can't carry it yet. The revenue quarter is real, and it doesn't touch the denominator. Fortinet matters more than the revenue beat does, because external foundry volume is the only thing that eventually makes that capex line rational.
So the beat isn't the story, the customer is, and Intel is now looking for help carrying it. The company committed this week to 14A mass production in 2028, and separately, it's seeking operating partners for the delayed Ohio fab, with SK Hynix exploring a role running the site rather than buying it.
Both of these are the same trade with different collateral. AMD is spending equity to buy demand it can't fully serve yet. Intel is spending capex to buy capacity nobody has ordered yet. The one with the customer is carrying 97 times. The one with the capacity is carrying negative free cash flow and looking for a partner to help run the building. Neither one converts on this quarter's numbers, and I'd revisit both on August 4th when AMD reports.
2 names, 1 page, both spending someone else's money to be in the same business. Neither has been paid yet. Which is the weak? Tesla asked to be valued as an industrial AI company in the same quarter its car economics went sideways. Deliveries hit 480,126 vehicles, a quarterly record. Revenue was $28.2 billion, up about 26% and ahead of consensus. Then adjusted earnings per share came in at 33 cents against 51 expected, with operating profit down 57% as regulatory credits collapsed. On the second quarter call, Elon Musk said, quote, "This is a massive capex year," end quote, and spent his time on robotics, silicon, and energy rather than on cars. Tesla also disclosed it bought an unnamed AI hardware company for $1.95 billion in stock during the quarter. On the regulatory side, the week split both ways. NHTSA denied a petition seeking a formal defect investigation into the emergency door release on about 180,000 vehicles, while the separate probe into full self-driving claims in low-visibility conditions is now at the engineering analysis stage. Celsius beat earnings and set a 52-week low on the same day, page 16 of the memo, and there are two reasons for that. On the print, 41 cents against 29 expected. The stock still touched 27.45. Reason 1. Core Celsius brand net sales grew 6%, a sharp deceleration from prior growth. Reason 2. England published plans to restrict high-caffeine energy drink sales to under 16s, pending a parliamentary vote. Bernstein upgraded into the low with a $44 target. 6 other brokers cut their targets and kept their buy ratings. Starbucks and Chipotle both report Wednesday off the same page. Oracle had the week that answers the question Hunt, Jason, and Mike asked on episode 2629, cheap or value trap. The Pentagon awarded Oracle a 10-year software consolidation contract worth up to $7 billion. In the same 7 days, S&P cut Oracle's credit rating over the data center capex, and Oracle sued Wisconsin regulators over a $7 billion collateral demand tied to a single data center near Madison. Trailing 12 free cash flow at Oracle is negative $19 billion against $56 billion of trailing capex. Both of those sentences are true at the same time. A 10-year government contract is exactly the kind of revenue that supports a credit rating. It arrived the same week a ratings agency decided the spending in front of it mattered more. Forward week, and it's the heaviest of the quarter. Page 1 of the memo prints almost all at once. Microsoft and Meta Wednesday, Apple and Amazon Thursday, Visa, PayPal, and UPS Tuesday, Palantir Monday the 3rd, and AMD Tuesday the 4th, which is when the Helios question gets its first real answer. That's the show. Wall Street's consensus on this week's announcements. Demand is now confirmed through 2030. Confirmed demand and collected cash are separated by about 4 years of capex, and exactly one company in the memo shortened that gap this week. Everything else you heard was a signature. Broadcom signed contracts that convert late in the decade. AMD signed a customer it can't fully serve until its software catches up. Intel signed one foundry customer and went looking for a partner to help run the building. Vernova banked $5.1 billion in 90 days. Hiring data this week from Talnexus, talnexus.com. Download the cash flow memo at telltales.us. Hunt, Jason, and Mike are back Wednesday on episode 2631. The AI build got signed this week. Watch who gets paid. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase, or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may